All right, you ready for some good news? All right. So, as we look at the U.S. economy, there's actually a number of things that make us a little bit concerned, but there's actually a lot of good data out there, and a lot of things that would at least indicate that this economy is not going to be heading into a recession, and the markets potentially have a more upward momentum that's possible. So the labor markets are continuing to show strength. The black line up there is showing the unemployment rate. And as you can see, it peaked in October 2009 at 10% and has been declining since. The most recent number is actually under 5%. It's at 4.9. And the light blue line is wage growth. And that has been definitely something that throughout this recovery has not been very strong. But in January's numbers, they were a little bit lower than the average labor numbers for 2015, so they were on the... So as I was mentioning, the wage growth has been kind of missing over the last part of the recovery, but in January's numbers, it's really been showing that... in January's numbers, they actually show that wage growth is coming back, right? So I was talking to one of the clients earlier, and even mentioning concerns over these labor numbers. They're not perfect by any means. There are many people who are not working at a level that they had before the recession. They're maybe not making as much money. So there's definitely some issues that exist in labor markets, but the fact is that there are more and more people working, and they're starting to see increases in their wages. And from an economic perspective, that's a good thing. That's going to lead into additional economic growth. And as Ryan mentioned, the consumer is the largest part of the economy, and that leads into increased corporate profits. The other thing, as far as the general economy, housing has been very strong. 2015 was a great year for existing housing sales, along with new housing development. And also, car sales were very high, in particular on the large truck side. So, those are things that would indicate the economy continuing to accelerate, not an economy that is slowing down. When we look at valuations, they're about average. So this black line there shows you the average price to earnings ratio since 1990. And so this is basically what this is saying is how much you're going to pay for $1 of earnings. And are you paying a lot, or are you getting a good deal? So you can see in 2000, things were very expensive, right? So that was during the tech bubble. People were paying a lot of money for not a lot in earnings. Whereas in 08 and in 2011, things were relatively inexpensive. So right now we're at average valuations. And what that means from an investor perspective is, really there's nothing screaming to go buy because of valuations, but there's nothing screaming to sell because of valuations as well. And this is kind of where we'd expect to be at this point in the business cycle. This chart is very insightful as far as understanding where we are in the business cycle. So it's looking at the leading economic indicators. And this is a whole set of indicators that are really forward-looking. And that's what's very important to be understanding is, you don't want to be looking at indicators that are more lagging of where the economy is, but more ones that are more predictive of where the future economy is going to go. The blue line is basically the performance of those indicators. The gray bars are recessions. And what you'll see is, those indicators go up over time and then decline, but they're generally trending upwards. And what you see is they'll peak at a particular point and then come back down, and then in the next recovery period, they'll start trending back upwards, and then eventually they go above the last peak. And what you can see is in each one of those times, in the 80s and the 90s and the 2000s, after they go above the peak, there's about anywhere from 6 to 4 to 8 years where they go before another recession comes. So we are now just getting to the peak that we saw in around 2006, 2007. So what this indicates is, we potentially could have anywhere from 3 to 6 to 8 years of additional growth in the economy based on what we're seeing with these forward-looking indicators. Exactly how long that is, we don't know, but it's certainly not indicating that we're on the downward slope of the economy right now. I think the important thing to remember is, in 08, the decline was so dramatic that although it seems like we've been in a bull market for a long time, we're basically coming out of a hole that is very deep. So it's going to be a longer recovery than in most periods. All right, so that's the good news. A lot of good news out there. There is some areas of concern, and we want to be very open with you as far as what we're looking at, and it's going to if we're seeing changes that in these areas or other areas, then this could basically make us make adjustments to the portfolio. So in this graph right here, there's two lines. The orange line is what's called the ISM non-manufacturing. So this basically looks at the non-manufacturing, the service area, and growth in that area. The light blue line is the ISM manufacturing. So this is looking at growth in the manufacturing space. Anything above 50, which is the dotted line, is indicating growth in that space. So you can see that over the last 5 or 6 years, there's been growth in both manufacturing and the non-manufacturing space. But it's only in the last year or two where you're starting to see a decline in the manufacturing area. So now it's below 50, which means there's actually there's some decline in that area. Whereas with the non-manufacturing, there's still growth. It's still above 50. Now, the important thing to remember, and Ryan pointed this out, is most of that decline is because of decline in the oil and natural gas space, right? So there was a lot of investment in that space, a lot of manufacturing that was occurring, and so that's what's bringing that down. What we'll be looking to watch is where does the non-manufacturing ISM curve go? If we see that trending downwards, that would perhaps change our view as to where the economy is going. But there's nothing to indicate that's happening now. And really, even in the last month's manufacturing numbers, as far as for labor, that area is actually growing again, which for the U.S. hasn't happened in many years to have a manufacturing actually growing. So, it's something that we're looking at. Right now, we're not overly concerned, but we'll continue watching it. Okay, so as far as earnings, so what this chart looks at is the gray bar is earnings expectations as of December 31st at the end of last year. The light blue bar is earnings forecast just over in the past few days. And unfortunately, they've declined. And in particular, as you can see, the majority of that decline is in the energy space. So there was supposed to be a decline in energy earnings, but not as dramatic as now they're forecasting. This is definitely something that we're watching as far as how far this has flowed through corporate earnings. The thing to remember with all of earnings, corporations want to kind of measure what the expectations are. So, as they start talking about 2016, they may be seeing some headwinds, but they also want to manage what Wall Street is expecting from them. Because the goal is they want to try to outperform those expectations. So you got to take this with a little bit of grain of salt, but certainly we'd like to see it going the other way, which it's not. So that's 2 points that showing a little bit of negativity in the U.S. economy. But the question becomes, all right, are we potentially going into recession, or is there any chance that we could have a situation like '08? And as Ryan mentioned, from our perspective, what we're seeing, that is not the case. It is very unlikely we're going to go into recession. Again, anything in economics is not black or white, though, right? So we're talking about what are the odds of something occurring. We think those odds are low. If most, 10 or 15% are the high teens. So pretty low as far as the chances of that occurring. The chance of an '08 occurring are even lower, and I'll go through the reason why we think that. So this is basically looking at household debt as a percentage of personal income. And what you can see in 4Q of 2007, there was a lot of debt on people's balance sheet, right? So you're at 13.2%, pretty much an all-time high. Since then, people have been paying that down. There was also, foreclosures and bankruptcy that wiped away those debts. And what you can see now, we're at one of the lowest points in the last 30 years. So, one of the problems, it's really a problem, one of the things that have been happening is, when people have been getting savings from lower oil and gas prices, they've been paying down debt, and they've been increasing their savings, which from an overall long-term economic perspective is a good thing. It may not be some of the growth that we were expecting in the consumer sector, but it means a healthier economy long-term. That same really strong balance sheet also exists on the corporate side. So this is looking at the amount of cash that exists with the S&P 500 companies as a percentage of current assets. And what you can see is, we've had a dramatic increase, in particular from '06, '07, '08 to where we are now. And really what this means is, companies have a lot of cash. And so, what that means is if something were to happen, they're in a good position to sustain their business. They're not cash strapped. They're in a position to invest in the business, to buy back stock, to provide dividends. All those things are good from a shareholder perspective. Finally, this is looking at bank loans to deposits. So really a ratio, the higher up it goes, it means that banks are lending out more money as a percentage of the loans they have on. And you can see in 2000 and then in 2005, those amounts were peaking at pretty high rates. At one point, you're above 1%. Since then, it's declined, right? And any of us know if you've been putting money at a bank, they're going to give you pretty much nothing for it, right? Because they're not really dying to have your money. They've got a lot of cash on their balance sheet. So the amount of loans they have as a percentage is so much lower. But the one thing I would tell you is we work with a lot of bankers, with their clients' businesses or whatnot. If you talk to bankers, they want to lend money. They're out there trying to lend money. They want to do it in a prudent fashion. They're willing to lower some of their lending standards, but not too much. So again, from an investor perspective, those are the things we want to hear, that their balance sheets are very strong. They're looking to lend money, but they're not going to lend it just to anybody. They want to make sure that whether you're an individual or business, that you're a viable entity. So just look quickly internationally. This is basically a trend line of international performance since 1970. So the blue line is the actual performance of the MSCI EFA, which is the developed international market performance. The orange line is the trend. So you're talking about a trend annually of about 6.5%. What you're seeing is, with a trend, they're going to have times that you're outperforming, like in this situation right here. And there's times that you're going to be underperforming like we are now. So the distance from the trend right now is around 34%. So that means over the last 4 or 5 years, we've been way off that trend line. And as Steve showed in one of his earlier charts, at some point you get what's called reversion around the mean, meaning that you're going to outperform over a period of time, and then you're going to underperform over a period of time, but you're going to get that trend line performance over time. So from our perspective, as we said all along, we don't know when international is going to come back, but at some point it's going to come back and it's going to outperform its average performance of 6.5%. And that's the importance of being diversified for when that happens. So with these 3 lines here, the red line is Japan's earnings index, the blue line is the US, and the orange line is Europe. And what you can see is when we first started off in 2008, 2009, all those earnings are kind of moving in conjunction with one another. And then what you see in 2010, Europe's kind of peels off and is flat for the last 5 or 6 years. Whereas Japan and the US have been increasing upwards. Now, the green stars are basically times when quantitative easing was going on. And so you saw that it started in the US around 2009. It started in Japan in 2012. And what you can see is earnings, in particular Japan, really start taking off when quantitative easing was in place. Europe just started doing it last year. And so the expectation is between quantitative easing and just the fact that usually those earnings go in tandem with one another, that you can see earnings in Europe get closer to where the US and Japan's earnings are. So we'll talk real briefly regarding fixed income. So this is basically the pyramid that we use to build out your fixed income allocation. So on top is real estate investment trusts. So these are publicly traded REITs that buy into everything from office towers to apartments to malls. And as owner of a REIT, what you're getting is both potential for appreciation and income. So anywhere from 3 to 4%. The other next piece is what's called core complement. So in this space, we have international bonds. So international bonds, what we like about those is most other countries are in a different interest rate cycle than we are. And so, they're in a process of lowering rates, which actually is very bullish for fixed income. And then the next 3 are our core holdings. So the floating rate fund, so in this fund, it's going to basically, interest rates are going to move in conjunction with market rates. So if rates go higher, that's actually a good thing for these bonds. The other 2, the short term and the core strategic, basically you have managers that are looking at whatever area they think is best to be in to mitigate interest rate risk and also to provide yield. But the important thing is, as investors, is that there's 2 purposes behind your fixed income allocation. One is capital preservation, right? So, right now, your allocation in your fixed income is actually positive for the year. So we want to make sure that if something is more of a crisis situation, that asset class is going to do well. And the other is income. And over time, that part of the portfolio is going to provide income. As we look at rates, in this situation, we're looking at the blue bar on top is rates from the UK. The gray bar is rates in the US. The light blue bar on the bottom is rates in Japan. And the negative bar below zero is actually rates in the Eurozone. So, you can see that when investors are looking at opportunities where to put their money, and now these are government rates that are out there, not corporate bonds, you can see that the markets, there's not a lot of opportunities as far as yield. Expectations from the market are that rates will go up in the U.S. So this is December 15, December 16, and then December 17. Rates slowly trending up. I think it's important. We don't know how quickly that's going to happen, but the expectation is that will occur with the assumption that the economy remains strong. If there's any weakness, I think the Fed has shown that it's going to be very slow in doing that. And then finally, question on, all right, we hear these concerns about junk bonds or high yield bonds, and what does that mean to an investor? First and foremost, really almost none of our portfolios have any allocation or very little allocation to junk bonds. That was removed last year. So there would be very little impact by rising rates in the high yield space. But even in there, really what you can see is the blue bar line is yields or spreads for energy. And then the gray bar is for anything that's not in that space. So what you can see is most of the concern is really in the energy space. And that only makes up 15% of the overall high yield market. So again, if you were a bank and you had lent a lot of money to oil and gas companies, you could have a problem. And there's certainly going to be some banks in Texas and North Dakota that are going to have some problems. But most of the big banks, national banks, have very little in the portfolios in that space.